Have you ever wondered how investing works? Let's dive into it. Investing, quite simply, is the act of putting your money or capital into something, expecting it to generate an additional income or profit. Think of it like planting a seed and waiting for it to grow into a tree that bears fruit. The seed is your initial investment. The tree represents the growth of that investment. And the fruit is the profit you reap. Now, you might ask, why is investing important? Well, investing is one of the most effective ways to grow your wealth over time. Just having your money sit in a savings account might keep it safe, but it won't significantly increase its value. In fact, due to inflation, the purchasing power of your money can decrease over time. Investing can help you beat inflation. Let's say you invest in a company's stock. As the company grows and becomes more profitable, the value of your investment grows as well. This growth often outpaces inflation, so your money retains its purchasing power. Investing is also an essential tool to achieve your financial goals, whether you're saving for a new car, a dream vacation, your child's college education, or your retirement. Investing can help you reach these goals faster. By investing, you're not just saving your money, you're growing it. But here's the thing about investing. It's not a get-rich-quick scheme. It requires patience, discipline, and a good understanding of financial markets and investment products. And just like with any other endeavor, it comes with its own set of risks. For example, the value of your investments can go up, but it can also go down based on a variety of factors like market conditions, economic trends, and company performance. So investing can be a great tool to boost your financial status, but it's not without its risks. Why should you consider investing in the stock market? Well, for starters, it's an arena that often offers higher potential returns compared to other investment types. It's like a wild roller coaster ride. It can be thrilling and nerve-wracking, but ultimately, it's an opportunity to grow your wealth more significantly than you could with safer, slower growing investments. Now let's talk about the magic of compound interest. Picture it as a snowball rolling down a hill, growing bigger and faster as it goes. When you invest in the stock market, not only can your initial investment grow, but the returns on that investment can also grow. Over time, this can lead to exponential growth of your wealth. The stock market isn't just about making quick wins. It's about playing the long game, leveraging the power of compound interest, and weathering the highs and lows for greater potential returns. Clearly, the stock market can be a powerful component in your investment strategy. To navigate the world of investing, you need to understand some basic terminology. Let's start with stocks. Stocks, or shares, represent ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. Now let's move on to bonds. Bonds are essentially loans made by investors to entities, such as corporations or governments. When you buy a bond, you're lending your money to the issuer in exchange for periodic interest payments and the return of the principal amount at a specified maturity date. Next up, we have dividends. Dividends are portions of a company's earnings that are distributed to shareholders. Not all companies pay dividends, but those that do typically distribute them on a regular basis, such as quarterly or annually. Now, let's talk about portfolios. A portfolio is a collection of financial investments like stocks, bonds, cash, mutual funds, and other investment vehicles. A well-diversified portfolio can help you spread your risk across different types of investments. Finally, we have risk tolerance. This term refers to your ability and willingness to lose some or all of your original investment in exchange for potential future returns. It's a crucial factor in determining your investment strategy. Are you a risk taker, willing to endure the market's ups and downs for potentially higher returns? Or are you more conservative, preferring to protect your initial investment? Now, how do these terms relate to the overall investing process? Well, stocks and bonds are the building blocks of your portfolio. They represent different types of investments you can make. Stocks are generally considered riskier, but offer higher potential returns. Bonds, on the other hand, are seen as safer, offering steady, but typically lower returns. Dividends can provide a regular income stream, especially attractive to those in retirement or looking for consistent earnings. Your portfolio should be a well-balanced mix of stocks, bonds, and other investments tailored to your risk tolerance and financial goals. As for risk tolerance, it influences how much of your portfolio is allocated to riskier assets like stocks versus safer ones like bonds. If you have a high risk tolerance, you might have a larger percentage of stocks in your portfolio. If you're more risk averse, you'll likely favor bonds or other lower risk investments. Remember, investing is not a one-size-fits-all process. It's about finding the right balance that suits your financial goals, risk tolerance, and time horizon. Understanding these basic terms is a significant first step towards becoming a savvy investor. With these terms in your arsenal, you're better equipped to make informed investment decisions. While investing can be profitable, it's important to understand the associated risks. Let's dive right in. The first risk that comes to mind when investing is the potential for financial loss. When you invest, you're essentially putting your money into a venture with the expectation of a future return. However, there's always the possibility that the venture won't pan out as expected. That promising startup might not become the next tech giant. That stock you've invested in might plummet. That's the risk of financial loss, and it's inherent in every investment. Moving on, let's talk about market volatility. The financial market is a bit like a roller coaster. It's filled with ups and downs, twists and turns. This fluctuation in the market is known as volatility. It's the reason why the value of your investment can increase one day and decrease the next. High volatility means higher risk, but it can also mean higher returns if you play your cards right. On the other hand, low volatility usually means lower risk and more steady, but possibly lower returns. The impact of market volatility on your investment returns can be significant. It can turn seemingly profitable investment into a loss, or it can boost your returns beyond your expectations. It's unpredictable and can be influenced by a myriad of factors, from economic indicators to geopolitical events. Last but not least, let's talk about risk tolerance. Everyone has a different level of comfort when it comes to taking risks. Some people are thrill seekers, ready to take on high-risk investments for the chance of high returns. Others prefer to play it safe, opting for low-risk investments that offer steady, albeit potentially lower, returns. It's critical to understand your own risk tolerance when making investment decisions. By understanding these risks, you can make more informed decisions and potentially avoid costly mistakes. So before you dive headfirst into the world of investing, take a moment to consider these risks and assess your own tolerance for them. It could make all the difference in your investing journey. So what have we learned about investing? Investing at its core is about putting money to work for you. It's a way to grow your wealth over time, turning the money you have today into more money in the future. It's more than just saving. It's actively participating in the financial markets with the aim of increasing your wealth. This is crucial for anyone who wants to achieve financial stability and build a secure future. We've also explored the benefits of investing in the stock market. It's a place where companies sell shares or small pieces of ownership, so to raise money for their operations. When you buy these shares, you become a part owner of the company. If the company does well, the value of your shares goes up and you make a profit. Plus, some companies also pay dividends, a portion of their profits, to their shareholders. The stock market, with its potential for high returns, can be a powerful engine for wealth creation. But it's not just about buying shares and hoping for the best. We've learned some basic investing terminology that can help you navigate the markets. Terms like stocks, bonds, dividends, and mutual funds are the building blocks of the investment world. Understanding these terms is essential for making informed decisions about where to put your money. However, investing is not without its risks. The value of your investments can go down as well as up, and there are no guarantees of profits. It's possible to lose all the money you put in. That's why it's important to diversify, spreading your investments across different types of assets and sectors to reduce risk. It's clear that investing is a complex field, and it's essential to make informed decisions. It's not just about picking the right stocks or timing the market perfectly. It's about understanding the risks, being patient, and sticking to a well thought out investment strategy. Remember, investing is a powerful tool for wealth creation, but it requires knowledge, patience, and a keen understanding of the risks involved.